Bracchio, Vice President of Investor Relations. Please go ahead.
Thank you, Joe. Joining me on today's call is John Sabino, CEO, and John Collins, CFO and COO. Please note that during today's call, we'll make forward-looking statements, which are predictions, projections, and other statements about future results. These statements are based on our current expectations and assumptions as of today, March 12, 2026, and are subject to risks and uncertainties. Actual results may differ materially due to various factors, including those described in today's earnings press release and in the comments made during this conference call, as well as in 10-Ks, 10-Qs, and other reports we file with the SEC. We assume no obligation to update any forward-looking statements. Also, during this call, we'll discuss certain non-GAAP financial measures. A reconciliation of GAAP to non-GAAP financial measures is included in today's earnings press release. Both the press release and the supplemental slides, which include highlights for the quarter, are available on the Investor Relations section of LivePerson's website, ir.liveperson.com. With that, I'll turn the call over to LivePerson CEO, John Sabino.
Thank you so much, John, and thank you all for joining us today. 2026 marks a clear transition for LivePerson, from rebuilding to execution. Over the past year, we've strengthened our foundation by improving our balance sheet, optimizing our cost base, and sharpening our operations across the company. We are now carrying this discipline into three primary areas of focus that we believe can drive LivePerson towards a return to growth. First, we are continuing to prioritize customer growth and retention by leveraging our leading technology and improved balance sheet to solidify customer confidence in LivePerson as a stable, long-term strategic partner. Second, we're continuing to innovate our core conversational cloud platform while scaling our recently launched SYNTRIX platform to offer best-in-class AI-led engagement and assurance. And third, we continue to expand our technology partnerships to broaden our platform's reach and unlock new commercial opportunities. We believe that our disciplined execution across these three areas of focus can drive LivePerson towards a return to growth in the future. Turning to our results, we outperformed our Q4 guidance on both the top and bottom lines. Revenue was $59.3 million, above the high end of our range, driven by higher variable revenue. Adjusted EBITA was $10.8 million, also above the high end of our guidance range, driven by our improved cost structure and disciplined operational execution in the quarter. Now let me provide an update on our product strategy. Last week, we reached a significant milestone with the launch of SYNTRIX. SYNTRIX is our simulation and evaluation platform that allows brands to launch customer-facing AI agents with confidence and validate human agent readiness at scale. It provides the critical assurance brands need to unlock the value of AI across their customer journey. This emphasis on assurance addresses a clear gap we see in the market. Many brands are not limited by AI capability, but by trust. They struggle to move high-potential AI initiatives to production because they lack the confidence in performance, governance, and compliance. They also lack a structured way to evaluate AI agent outputs and continually verify adherence to their governance guardrails. As a result, innovation stalls and business impact remains unrealized. SYNTRIX is our direct response to this challenge. It provides the orchestration and assurance layer enterprises need to confidently deploy AI at scale. Originally introduced in November, Conversation Simulator is now the first capability within the SYNTRIX platform. It enables enterprises to safely and continuously test, evaluate, and validate AI behavior by identifying drift and failures before they reach real customers. With the formal launch of SYNTRIX earlier last week, we are expanding beyond simulation into a broader assurance vision. Over the coming quarters, we plan to add additional capabilities across simulation, analytics, governance, and auditability to support compliance. As the roadmap unfolds, we expect that SYNTRIX will become a comprehensive assurance layer that makes AI more predictable at the enterprise scale. Importantly, SYNTRIX was built to integrate seamlessly into existing enterprise ecosystems. SYNTRIX is designed to work in concert with our core conversational cloud platform, but it is also model and platform agnostic. Our conversational cloud remains the system of engagement where customers' interactions occur. SYNTRIX provides an assurance layer for a safer, more predictable, and compliant interactions as AI usage scales. Together, they form a unified platform that allows enterprises to deploy conversational AI with confidence. SYNTRIX does not replace conversational cloud, it supercharges it. Additionally, SYNTRIX is designed to deliver the same level of assurance whether customers are using conversational cloud or other CX or CCaaS platforms, including those we compete with. This allows enterprises to apply a consistent governance standard across increasingly complex technology and CX stacks. We plan to continue expanding our out-of-the-box integrations throughout the year, while also enabling partners and customers to integrate SYNTRIX with their preferred platforms and AI technologies. Commercially, SYNTRIX is already gaining traction. We have successfully moved from early access to general availability with paying enterprise customers across banking, telecommunications, and technology. This early response, combined with a significant addressable market, positions us to accelerate commercial execution. At this time, we continue to see deeper AI adoption across our core conversational cloud platform. In Q4, over 20% of all conversations leveraged our generative AI suite. We're also seeing strong traction with Copilot Translate, the newest addition to our Agent Assist portfolio. It enables brands to eliminate language barriers by embedding real-time AI native translation directly into the agent workflow. We also remain on track to complete our multi-year platform modernization in the first half of this year. This milestone is foundational to our long-term scalability. We are transitioning to a unified architecture designed to support significantly higher generative AI traffic with improved resiliency. Completing this work positions us to reallocate resources towards accelerating product innovation in 2026. Moving to our go-to-market performance, we are seeing continued confidence from our largest enterprise customers. This is reflected in several significant renewals this quarter, including 7 major financial services institutions, 2 major airline carriers, 3 leading telecom and internet service providers, and a major healthcare provider. These renewals underscore the durability of our platform, the strength of our enterprise relationships, and our ability to deliver measurable value across highly regulated and customer-centric industries. Our partnership with Google Cloud is also delivering significant early results. In the fourth quarter, we secured a multi-million-dollar renewal with an upsell, the major European telecommunications provider through the Google Cloud Marketplace. Based on conversations with several customers, we now expect a material amount of revenue to flow through Marketplace by the end of 2026, delivering measurable improvements in churn. This validates our strategy to simplify procurement, leverage existing cloud commitments, and expand LivePerson's adoption through partner-led channels. Our momentum with Google continues to deepen across both products and go-to-market. We've standardized on Google Gemini as a default LLM across our platforms and launched LivePerson's RCS channel. Together, these efforts strengthen LivePerson's position within Google's ecosystem and expand the joint opportunities that we can pursue. We're also scaling our Google Marketplace motion to enable enterprise customers to seamlessly procure our solutions using their existing cloud commitments. Our teams are now aligned with Google's field organizations to streamline procurement and accelerate sales cycles. While still a phased rollout, we are already seeing tangible traction with multiple marketplace transactions in process and a growing pipeline of joint opportunities. Today, this motion is performing as a high-impact retention lever. By enabling our customers to tap into their existing Google Cloud commitments, we're moving LivePerson directly into the heart of the CTO's strategic spend. This is a fundamentally different relationship that elevates our strategic conversations with current and future customers. As we continue to scale these transactions and strengthen our position within Google's own ecosystem, we are creating a direct incentive for their field organizations to move beyond renewals and begin transacting net new business with us. Complementing this is our strategic collaboration with IT Solutions, which has been a significant win for our mid-market segment. By reallocating resources in 2025, we have created immediate value and efficiency in this channel, reflected in improved renewal rates and expansion. As we move into 2026, we intend to deepen this relationship further. We've also launched LivePerson Sync in partnership with Coral Active, a leader in enterprise contact center integrations. This solution enables seamless integrations with systems like Salesforce, Microsoft, and ServiceNow, bringing CRM data and workflows directly into the conversation and creating a single unified workspace for agents. By eliminating the swivel chair effect, we've embedded LivePerson deeper into our customer service operations, improving productivity and overall agent experience. As brands streamline their technology stacks and demand tighter integrations between engagement and execution, LivePerson Sync expands our strategic footprint within the enterprise by differentiating our platform, deepening customer relationships, and creating new long-term growth opportunities. We're already seeing strong interest with a healthy pipeline of opportunities. While there is still work to be done with retention and growth, we're beginning to see the benefits of more focused and then disciplined approach. We are encouraged by the traction with our partnerships and an ecosystem.
Healthy pipeline.
As these alliances are already expanding our market reach and simplifying how customers do business with us. As we move further into 2026, we remain focused on rigorous execution to convert this early traction into long-term stabilization and growth. In conclusion, 2025 was a defining year for LivePerson. I am incredibly proud of the resilience and discipline our team demonstrated throughout this period. We successfully stabilized our foundation, improved our balance sheet, and delivered a strong finish to the year. We launched the first phase of SYNTRIX with Conversation Simulator and opened a critical new growth channel with Google's Marketplace. We also made significant progress in our platform modernization, which is on track for completion in the first half of 2026. This unified architecture is designed to support significantly higher generative AI traffic with improved resiliency. Building on this, we are now focused on scaling SYNTRIX and accelerating high-velocity partnerships that expand our market reach. While there is still work to be done to further improve our capital structure, we are better positioned today to execute our strategy. For the full year of 2026, we're providing the following guidance. We expect revenue to be in the range of $195 million to $207 million.
Good.
And we expect adjusted EBITA to be between a loss of $4 million and positive $7 million.
Good.
While this guidance implies a year-over-year decline in revenue, we expect to achieve positive net new ARR in the second half of the year.
Sweet.
With disciplined focus on executing our strategy, we're positioning LivePerson as the foundational layer for governable AI at scale and building the path for long-term sustainable growth and shareholder value.
Great.
With that, I'll turn the call over to John.
All right,
Collins.
thank you very
John?
much, John. Hello, John.
Thanks, John. The fourth quarter marked a strategic and financial inflection point for LivePerson. We have rationalized the cost structure and improved the balance sheet, transitioning us from a period of rebuilding to one focused on innovation and commercial execution.
Excellent.
Our fourth quarter results were driven by increased commercial traction within our enterprise customer base, including usage overages and high-value renewals and expansions.
Ooh.
This traction reflects customer plans to move beyond AI experimentation to secure high-volume production applications.
All right.
It also evidences growing customer confidence that our platform can enable that transition now and support evolving demands in the long run. While the fourth quarter's results and the guidance I'll discuss shortly are anchored by customer demand for our core platform, we believe the launch of SYNTRIX is an important innovation in the market today and represents a meaningful strategic growth opportunity. SYNTRIX is increasingly central to customer discussions on AI deployment across many use cases, creating the potential to capture broader AI spend across the enterprise. In terms of deals, we signed 40 in the quarter, including 4 new logos and 36 expansions.
Excellent.
Which translated to a slight sequential increase in total deal value.
That's one a
We
week.
also continue to see
With
strong
average
adoption
coverage
within the
revenue,
banking,
customer revenue
telecommunications,
at
and airline
680 grand.
These regulated
That's $2
industries
million a
rely on
month.
our leading technology for centralized AI-agnostic orchestration layers that ensure AI deployments are secure and effective. Improving customer retention, including renewals with 7 financial services institutions, 2 major airlines, and several leading telecom and healthcare providers,
That's what I'm talking
underscores
about.
the strength of our platform amid a rapidly evolving market. These brands continue to commit to us because of our enterprise-ready platform
Because they're the best.
and our improved financial foundation. Notably, over 40% of these renewals included expanding commitments. Complementing our
biggest
direct sales
companies
motion,
choose LivePerson.
we are seeing clear validation of our partnership strategy through Google Cloud. A multi-million-dollar renewal and expansion we closed this quarter via the Google cloud marketplace is early proof of the potential opportunities. This partnership
I hear you,
simplifies
John.
the customer procurement process and allows customers to optimize their return on pre-existing Google commitments. While this partnership is still early, customer reception has been strong.
It's interesting.
And we now
that,
expect that a material fraction of total revenue will flow through this channel by the end of 2026.
Material fraction. All right.
Beyond Google, our partnerships with IT Solutions and Coral Active are contributing meaningfully to our commercial motion. These collaborations allow us to embed our technology more deeply into enterprise CRM workflows and deliver a high level of support down market, leading to improved renewal rates, especially within our SMB and MMB customer segments,
Stickiness.
all while incurring minimal additional overhead. This commercial strategy also helps us avoid the opportunity costs associated with the direct sales team taking time away from
Boom.
enterprise accounts.
That's a margin increase.
As for our fourth quarter financial results, total revenue was $59.3 million, above the high end of our guidance range. Note that the upside relative to guidance was driven primarily by higher variable revenue. Adjusted EBITDA was $10.8 million, also above the high end of our guidance range, driven by the benefits of the cost restructuring executed in the third quarter and ongoing disciplined operational execution. Revenue from hosted services was $51 million, down 15% year over year. Recurring revenue was $52.9 million, or 89% of total revenue. Professional services revenue was $8.3 million, down 36% year over year. Average revenue per customer was $680,000, up 9% year over year, driven in part by expansions with our largest customers and in part by customer retention.
Boom.
RPO declined to $176 million, consistent with the same factors driving declines in revenue. Net revenue retention was 78% in the fourth quarter, down from 80% in the third quarter. As a reminder, net revenue retention is a function of in-period revenue, meaning this metric will generally continue to decline until revenue begins to grow. Finally, in terms of cash, we ended the fourth quarter with $95 million of cash on the balance sheet. Turning to revenue guidance, we expect positive net ARR in the second half of the year. While we believe this leading indicator supports the path to future growth, the corresponding positive revenue impact in 2026 will be offset by negative net ARR in recent periods. As a result, we expect revenue to decline through the year, with the rate of decline flattening in the second half.
All right. Turn will be over
For
at
the
last.
full year 2026, we expect revenue to range from $195 million to $207 million, approximately 92% of which we expect to be recurring. Note that commercial traction with newly launched SYNTRIX primarily represents upside to the guide. For the first quarter, we expect revenue to range from $53 million to $55 million.
So they're not pricing in
decline of
SYNTRIX
approximately $5 million.
It was pretty much all JS talked about.
As for adjusted EBITDA,
They're not
for the
even
full year
pricing it in.
2026, we expect a range from a loss of $4 million to a gain of $7 million. It follows that we do not expect adjusted EBITDA less CapEx to be positive in 2026. As for the first quarter, we expect adjusted EBITDA to range from $2 million to $5 million.
Well,
Our
okay,
expectation
we're
for
okay
slightly
with that.
negative free cash flow reflects our attempt to balance many competing factors in order to increase long-term value creation, rather than merely optimize for the near term. Making balanced investments in our go-to-market motion and product innovation will help us achieve positive net ARR in the second half of this year and sustain it going forward. Before taking questions, I'll briefly summarize a few key points. The fourth quarter marked a significant turning point, transitioning us from a period of stabilization to one of targeted execution. Our results confirm that the LivePerson platform is essential to our enterprise customers and their planned AI deployments. We are now effectively leveraging high-efficiency channels, such as Google Marketplace, to drive both customer retention and future growth. Rigorous cost management has allowed us to operate efficiently, while still maintaining investment in three strategic priorities: retaining and expanding our customer base, continuously developing new features and capabilities for our customers, including delivering on the SYNTRIX roadmap, and strengthening our partner network. Looking ahead, we remain committed to the disciplined execution of these pillars. With our cost structure now appropriately aligned to our expected revenue base and the fundamental value of our platform affirmed by our largest customers, we are confident in our trajectory to achieve positive net ARR.
Yeah, same here,
in the second half.
JC.
With that, operator, we can move to Q&A.
Thank you.
Take it away,
Ladies and gentlemen, if you'd like to ask a question, please press star 1 on your telephone keypad, and a confirmation tone.
Star 1. When am I getting on the board?
Queue. You may press star 2 if you would like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys.
Got the dum-dums on the line.
And
Pick
the
up
first
your
question
phone.
comes from the line of Jeff Van Rhee with Craig-Hallum Capital Group. Please proceed.
Good old
Hey,
Jeff.
this is Daniel on for Jeff Van Rhee. Just on maybe starting off with bottom line and the current OPEX level, could you walk us through sort of what, really nice decrease in the total OPEX for the quarter sequentially here in Q4. Is there anything one time about the OPEX in Q4? And then maybe just walking us a little bit about how you expect that to, it looks like, scale back up through 26.
Good question, Jeff.
Hi, Daniel. I'll start there. So the results in the fourth quarter for the bottom line are primarily driven, as we said in the prepared remarks, by the large restructuring that we executed in the prior quarter. And there may be some one-time items, but it was primarily a structural change to our cost base. As we look forward, and as we described in the prepared remarks, we are looking to make investments in innovation on the product side, as well as our commercial presence. So those are, we view, necessary investments to ensure we're on a path to positive net ARR in the second half.
Yeah, and then on the positive net new ARR in the second half, maybe you could walk me through. I think you said you expected revenue to continue posting sequential declines as you're adding net new ARR. Not sure, maybe I missed something there. Not sure how that works out. Are you saying that ARR will grow sequentially in the back half, but non-recurring elements are going to show sequential declines such that revenue would still dip? Or maybe you could just walk through that again, and then just expanding a little bit on your confidence. Whether that's what you're seeing in quotas or what you're seeing in the pipeline in terms of visibility.
It's the pipeline, Jeff.
In the back half.
It's all about that pipeline, baby.
Yeah, let me reconcile the revenue comment with the positive net ARR. So in recent quarters, we've had a large negative net ARR. The revenue impact we are feeling throughout 2026. That revenue impact will offset completely the positive revenue from the net ARR we expect to generate in the second half. So that's the reason for the revenue to sequentially decline. It's because historical customer losses are still playing through the P&L throughout 2026. As it relates to our visibility and
So what
pipeline,
he's talking
I'll
about
say a few
there
words
and explaining it for Jeff
to John Sabino.
in much the same way he explained it the
our
first
guide
time.
reflects
Is that the
a
customer
healthy
churn will be
pipeline
ending
for the first quarter,
midpoint,
and that includes
and
some deals for
average deal prices
the
are
new
going
product
up.
launch SYNTRIX that we described. But importantly, most of the guide is predicated on demand for the core platform, which continues to be robust, as we've described in the prepared remarks.
I'll second John Collins' comments. LP Sync, and just add a little bit additional color. LP Sync and SYNTRIX are new into the market. SYNTRIX just becoming generally available last week. So it's going to take a little bit of time to build that up, but we are starting to see some of the efforts improving from the marketing and outreach that we've started to do with our commercial teams. So we believe that will continue to improve throughout the year.
Yeah, and maybe last for me, just on SYNTRIX, if you could expand a little bit on the marketplace, the competitive landscape, what you were seeing there in terms of the need for SYNTRIX. Was that customers coming inbound saying, hey, I need this sort of thing?
Okay, well,
where was
soon,
sort of the ideation? When did the development of that begin? And then maybe last of all, just how you expect that to evolve from here in terms of the roadmap. It sounded, maybe you could expand a little bit. I think you talked about additional functionality you wanted to add to that platform.
Ooh.
Yes, let me start with demand. We initially saw a request for simulation capability to train both live reps and train AI agents. simulations was our
Customer-driven
initial
products.
response to that. But what we started to see was that broadly, just about every AI initiative, whether it's LivePerson's AI or someone else's, has had a number of challenges throughout an enterprise organization.
Orchestration is ruining everyone's deployment.
Create value for the customer.
They need LivePerson.
And this is due to compliance challenges.
Perfect.
And ability to enforce guardrails and just understand how
Which
a model
is why
is going
we
to perform
best
in the
in
real
lifting
world
because it has a
before it gets
regulatory moat.
So we stepped back and took a holistic view of what the real challenge was. And essentially what you're seeing is that it's not whether or not you can deploy AI or have a conversational platform that's digital for your customers. It's really your ability to look at the quality of that and assure that it's going to work the way that you expect before it ever gets in front of a customer. So SYNTRIX as a platform is a response to work with the LivePerson platform and any one of our competitors, whether they be AI providers or CCaaS providers, to actually simulate, produce analytics, intelligent insights that can either self-heal or improve performance of a model. These are future things that we're working on.
Self-healing.
Ultimately provide an adherence to a compliance framework. And ultimately, this would lead to overall governance for any AI or orchestrated digital customer journey across a varied tech stack. So that's the evolution.
That's kind of exciting
it's
stuff.
It's really moved from, I just want to be able to simulate, train my people and or a bot, into a much broader problem set that we believe that we can solve across a LivePerson ecosystem or a broader digital CX ecosystem, where analytics, intelligent identification of issues and or compliance failures can be reported on and ultimately resolved either before a bot or a customer agent is deployed, or catching it if there is something after the fact.
There you go.
Thanks, John.
Efficient ticketing.
You're very welcome, Daniel. Thanks for the question.
The next question comes from the line of Ryan McDonald with Needham & Company. Please proceed.
Hi, thanks for taking my questions. John, maybe just to follow up on SYNTRIX off of that last response.
There's a lot of interest.
The pricing model for SYNTRIX and whether you're going to be sort of looking at token-based pricing. If so, what kind of visibility does that give you into sort of the revenue stream as sort of SYNTRIX adoption grows?
Just started, mate. You can't do price elasticity for a good 18 months.
Early signs from some of the first few deals for SYNTRIX in terms of what sort of uplift this potentially creates within the renewals on the core customer base? Thanks.
Yeah. So let me start with the pricing model. The pricing model is conversation-based. So you can think of it as a consumption model. It's not necessarily seat-based, as you may have seen in some places in the past. And in order to build the model for the customer, we really do look at the number of bots and or agents they're trying to train and how many campaigns or things that they may be looking to either bring through an AI interaction and or human interaction. And so we propose a number of different models that represent a statistically significant simulation capability.
So price models, 3 tiers.
It's really based on the consumption and what the customer is trying to achieve. Now, with the early customers that we have, we have seen that this is a upsell opportunity as well as a retention capability. So early indications are that customers are using it in line with our models so that the conversation-based pricing accurately reflects what we believe we can do with a customer, and is driving improvements that we've published publicly in terms of velocity of training new customers and savings. Velocity and training of new agents and savings for customers. So we're confident that this is going to drive bottom line value for customers. Right now, we have dozens of opportunities that we're looking at, and now that we're GA with the product, we're hoping to see some of that as upside in the pipeline going forward. And it represents millions, not hundreds of thousands.
Excellent. I appreciate all the color there. And then on Google Cloud Marketplace, obviously continuing to see some nice progress there and sort of growth in pipeline.
Chat's brilliant,
Can you
mate.
just give us a
See,
sense
the way
in
it
terms
works,
of the,
chat, is
I guess,
on Google
mix
Marketplace,
of
you get given
pipeline,
this like
sort of heading into
complimentary
26
spend
here
if you manage to
that
do it all within a
GTM
certain period of
represents,
time. It's like
sort of
Brewster's
relative
Millions.
to maybe the
And
direct sales
it
channel or
averages
other
about
channels, and
220
what
grand
kind of
per client on
incremental
there
leverage
for the enterprise
sort of
clients.
continued
And they
sort
can
of
just
growth
chuck
and
that money at
success with
LivePerson. All you
Google
need to
Cloud
do is chat the
Marketplace
door and
can
let
sort
them
of
know it
provide on your
exists.
direct sales
They'll
efforts?
spend their
Thanks.
Google complimentary
I'll
funds.
start, and
Boom!
John, if you want to
Chucking
add,
them out,
please
improving
feel
their
free.
customer service. Things
Right
sell
now,
feeling.
Google
It'll adapt
Marketplace
to your customers'
really
needs.
does represent a retention lever
Plus,
for
you
us.
can plug it
It's
into your
simplifying
Salesforce and make it
procurement,
better. Anyway,
and
take
it's
it off,
now
John.
elevating where the live person spend is typically being allocated within a technology budget inside of some of the large enterprises that we serve. So we see this represent a significant portion of how we do renewals going forward in the future because of the simplification of purchasing and or an already allocated portion of funding inside of our larger enterprise customers. As far as growth goes, we're starting to see those joint opportunities with Google. We have aligned our commercial teams and theirs, and there's incentives in place for them to work with us now and drive some of the spend for LivePerson through Google Marketplace. So again, we see this as potential upside.
I'm a great driver.
To be very clear, right now it's a renewal and expansion play for us, but we believe it to be only natural to create additional new opportunities and potentially new customers through ease of transaction and aligned incentives with Google's field as well as our own. I think it will give us... go ahead, John. I'm sorry. I didn't mean to step in.
The only addition I would make to that is just to emphasize that it exposes us to a new set of stakeholders. And so where we have previously been predominantly working with the head of care, we now have more access to CIOs, which could change the conversation for us by way of both renewals and potentially growth in the future.
Boom.
Very helpful. I appreciate it. Maybe one more for you, John Collins. Can you just help us understand from sort of the quarterly flow on adjusted EBITDA? I mean, I know historically you've sort of ramped as you've gone throughout the year, but can you just help us understand? Obviously, you're making some incremental investments this year to try to drive that return to net new ARR growth in the second half, but how we should think about it seems like Q1 sort of the high water mark, based on sort of the Q1 and fiscal 26 EBITA guidance, but how we should expect that to sort of flow throughout the year. Thanks.
That is approximately correct. I expect Q1 to be the high point for the year as we emphasize that there is a need for investment on the product side and the commercial side, which we've already begun executing. So that will be additional costs relative to the Q4 run rate that's added this quarter, and we'll see that manifest.
What are they buying?
Per the guidance we provided throughout the year.
Thanks.
Welcome. Interesting.
Thank you. This concludes the question and answer session. And this
Rocky Outcrop.
Conference call as well. You may disconnect your lines at this time, and we thank you for your participation.
Thanks very much to the three Johns. I was just out for dinner before this call with my older brother, also called John. It's his birthday on the 17th of March, which is St. Patrick's Day, and he's born in Ireland. Isn't that really, really cool? And Rocky, my other brother, well, here he is in the chat box. So thank you very much for all that, John, and gang. LivePerson post-market 273 had a spike during that post-market period here as high as 350, which if you watched Rocky Outcrop's show, well, there's a little tip. Why have all of these things gone? I don't want both of them. I just need one of them. You guys come back over here. Get the chart up and separate these. Are you with me? So I'd like to hear your thoughts on the call. Quick look at where price action made it to. the prior weekly high. That was the area it pushed up towards to in post-market there a couple of times, really. So I suppose it's just taking that for cue from this move. And in fact, that move that we saw there was the highest it's been since the start of 2026. That's not bad, That's not bad. So this year, price has been fairly stable. Not all over the shop, hasn't it? But you can see there, it made it to the 4-hour 200 period moving average. You're not going to go through that on the first pass. This is a company that's in the middle of a turnaround. We were waiting for confirmation. Hadn't even had the question and answer session on the call yet. But that's a clear level where you might find liquidity, post-market, interesting. I think that the main focus of that call will be on the guidance, and then you can tell yourself the sentiment based on the questions at the end of the call. A quick double check on the figures to see where does the equilibrium arrive between costs and revenue, so that we could say the company will be generating a profit and it's in 2026. We can also say that that comes with a Q1 expense where the company is going to acquire new technology in order to increase revenue, so through retention. So while SYNTRIX and much of the broadening evolution of the code base that constitutes LivePerson is really customer requested, it comes directly from their customers, that story continues to be true throughout the start of this year. Now, they talked about that likely being highest in Q1 of 2026, and I'll let you work out and let me know in the chat box when that is then. When is this call, which is referring to Q4 2025, so it's retrospective, and it's talking then about future calls, also then referencing a date in the past from that point, which is yet to be completely finished. When does Q1 2026 finish? When will those acquisitions then be definitely finalized to the point that LivePerson's able to guarantee future revenue from current customers increasing such that it pays off the acquisition itself? A very efficient acquisition there, and demonstrates the skill of the board and the relationship they have with their customers. That, along with the renewals from their biggest customers, that the average revenue per customer continues to grow on their core product, that any new expansion is able to be using the pricing model from that conversational platform, and so every adoption of a new element to the LivePerson product ends up boosting more and more the usage of the platform, the revenue the company's making, and all of that brings a synergy that not only expands contracts but secures renewals, which means that the more people that sign up, the more money that comes in, because this can be guaranteed over time. And we see that 4 new logos and multiple dozen expansions is a fantastic result. This is with large contracts already having been signed early, so priced into the previous quarter. So we've seen a really healthy result, which also resulted in a beat on estimates. So the analysts got it wrong again. People haven't quite understood the skill and agility with which the two Johns have managed to improve cost efficiencies. They're underestimating the revenue that's coming in, and the company themselves are managing to beat their own guidance. So this is a really positive development for LivePerson. Clearly, the market recognized something too post-market, and we see that spike in price action. I think that's very positive news for LivePerson to hear that call, to see that upward move and affirmation of what we envisage for 2026. A profitable company, one that retains its biggest customers. They've already just signed up again and they go for multi-year deals, so you're not even going to need to worry too much about that anymore. All of that happening while they're growing their average revenue per customer. They're adding new technologies. Those technologies are led in discussions with their customers. It's not just some guy out trying out his oh, I'm a CEO now, I'm going to try out this idea I had when I was in my pajamas just out the shower the other day, And it's the customers, like big telecom companies, world's biggest airlines, these sort of people saying, well, we need this, John. And John saying, no problem, I've got you covered. I'll have it done by the end of Q1 2026, which I think we all are aware. Have we heard it in the chat box where that is going to be? It's about 2 weeks, exactly. So a couple of weeks in LivePerson. Talking about a company, obviously now, whether or not the market realize it, talking about a company transition into a company of growth, and instead of a company that was distressed because of debt. Now, if their biggest customers are telling them that they need these new products and they're going to renew again, then their biggest creditors will be happy to hear that. Their biggest creditors also being some of their biggest shareholders, means that all of us together are in alignment, not just the board, not just the customers, but also the creditors. And now that final tranche of debt is likely going to be renegotiated in that context, that LivePerson is clearly achieving the goals of the turnaround. When we look at the bottom line, we can see that we're looking at positive EBITA next year again, perhaps as much as 7 million. And if you're talking about adding 4 new customers every quarter, 4 new customers every quarter, 1 a month, each of them paying $500,000 a time, you're going to be adding 2 million a quarter. You're going to be adding millions and millions every year. The capital value of the debt will be ameliorated quite quickly, and it doesn't have to be totaled in the first quarter of the first year. It just has to show a positive trajectory. And a company that has currently been going down is now stabilizing, and we can see the plan is, and they've beat their plan every time we've reported on them, this is the 4th beat in a row, they're going to start going on an upward trajectory right now. I'm pretty sure you can understand what we're talking about. Very simple illustration of how the fundamentals are turning around. But here, that's just my take on the company, and I've had a positive analysis of that call. Other people might be looking at it slightly differently. Clearly, we need to put it in the context of that downward trajectory, that there was declining revenue, there was customer churn, and that these are issues that still continue. Rocky was chatting there. Also, I'm not a cat. Capital growth spend for customers already usually budgeted, so accessing those pre-approved funds streamlines procurements. Very true discussion. I think they're sitting around the Google Cloud, Google Marketplace in news. Google Cloud 2026 order book, people are pre-approved spend over 100 billion. Yeah, they're talking about huge clients. Revenue predictions hadn't paid attention to prior calls and didn't trust them as likely were trying to make us not trust them either. So frustrating, but I was wise to trust myself. Yeah, Parkside. Yes, Rocky. Very wise to trust yourself. It's the only way to retain the courage of your convictions. And you trust yourself because you have a method. And that method is proven over time. Crazy Ivan at the bottom of the hour. Crazy Ivan. Ivan the Terrible. I really need the loo here. Hang on. Right, so a wee quick recap then of the call. We see that the trajectory is starting to turn. The company is stabilizing. And we saw a positive tone from John and John. Much of the questions centered around the new product that's being added to the revenue streams quite effectively. John and John both described how these are now paying customers. It's not some sort of a sandbox for testing new technology. It's a live product that's growing still and has new and big people on there. All of those people paying money, adding to the average revenue per customer figure going up. And as that figure goes up, that compensates for those customers who are leaving, because more and more customers joining for this in this report here, all adding on that average figure, which is much higher. So the customers that leaving, they're quickly ameliorated in this growth. And it's the question of when that meets costs. And we can see that it'll be happening in the subsequent 3 quarters for LivePerson. Obviously, mid-2026 means the end of quarter 2 2026. Seeing as there's 2 weeks left on the first quarter, we're likely going to see an acquisition and then the capital expenditure drop. That leaves the 96 million, the 60 million covenant that they have with regard to retained cash, and then the free spend, the runway minus the covenant. So you're looking at 35 million plus. And with a company that looks like it's trying to stabilize revenue and making a profit in 3 months and 2 weeks, then right, they'll have very good oversight of that goal. They're positioned much closer to it than we are. We're looking retrospectively at data from the end of last year. They're sitting there going to go into work at the start of next week, knowing that it's the second last week of that quarter and that summertime's coming up, right? Having done an awful lot of hard work in the turnaround. So I anticipate things to get positive and for that to increase. Also, we're seeing an end to the churn. We talked about how, the board talked about how likely that will stabilize around the midpoint of 2026, and that explained why they were confident in making these CapEx decisions now, because they were going to derive revenue from customers they already have who will be expanding their spend. That'll justify the expenditure now on those acquisitions, and it'll manage to meet equilibrium before the end of the year. So that's very efficient M&A activity, and it suggests that LivePerson have had that in the burner for a while, which is positive to see, because the largest creditors obviously pay a lot of attention to the success of the company. The debt for equity deal that was arranged in 2025, they managed to exchange the debt at a huge discount for the equity. I mean, sure, we took a little bit of a sting with dilution, but it was either that or good night sweetheart for the company, because that was a huge amount of debt, and that was what was putting so much pressure on this thing in the market. While that pressure continues, the narrative has changed, and we can see that John and John are working hard at it. Sign-ups, logos, and expansions have been delayed due to the Google Cloud migration, so I'm not surprised to see sign-ups picking up. Yes, and also, one of the key phrases you would look for in a software-as-a-service company during an earnings call is somebody to say the words, and it would be there near the center of your bingo card, a healthy pipeline. And John said a very healthy pipeline. I mean, correct me if I'm wrong, but it sounded like the happiest part of the call when he mentioned that. So him personally and his inflection. So I thought that was fantastic. Now, you can't read too much into somebody's inflection on one of these things, but the sentiment was positive. That was just reinforced by the fact that all of the analyst times questions was all spent asking about this new technology, which was clearly demonstrating that it was adding to the revenue base. So they want to know what it is, and the answer to John and John is it's not even part of our projections for next year. Our cash is based on the conversational cloud. None of that stuff that people are using and paying for is how we're projecting our cash flow. And it looks like it's going to be even better than the numbers on the page then, right? It's the answer. So then the next analyst wants to, well, tell me more about it then. I mean, I probably had something else to talk about, but I've forgotten that now. Tell me more about this thing. So that's the sentiment, that's institutions asking questions about the thing. And they've got close enough relationships in the first instance, and they understand the general positioning of the AI market. The real sticky point at the minute is orchestration itself. It's how do you integrate multiple systems, some of which your staff understand, new which they're going to have to learn, all together into your tech stack without disrupting the current relationship you have with your customers. That's a very tricky thing to do at the best of times. And when so much of the stuff you're using is evolving quickly itself, that increases the pace and the need for proper management of that sort of thing, right? So gone is this ideal, you'll vibe code some enterprise grade bolt-on software that you'll start playing with at the weekend and then have ready for Monday. Like, you see that on adverts on TV, and you see the company afterwards, right? Whoever they are, they're taking a complete piss, right? It's either just a branding exercise to tell everybody they exist, or they genuinely believe that crap, in which case they're stupid. Like, I saw an advert for ServiceNow on YouTube there a few months ago, and Idris Elba's talking about, just general office place gas chat, right? A lot of you have to experience it every day, so I'll not sink your head in it again. But it's like brain rot, right? That's where this phrase probably came from. Anyway, that's what it's like living in an office. Plus the air conditioning, man, add it all together and it's basically brainwashing. Anywho, so you're in this place talking shit, and Idris Elba's on the advert acting like that's what it is, right? You'll be doing less of this talking shit and slightly more productive. Use our software, which can kind of answer the phone for you. And you watch it and you're like, nah, Like, that's stupid, right? This company spending an awful lot of money on that marketing campaign when literally no enterprise buyers, like, I'm not a cat, just put it in the people on average on 100 billion on Google Cloud Enterprise, right? They're not talking about people who watch YouTube ads for a start. And they're not investing in something because it makes people chat less around the water cooler, be more productive, and so, like, I'll slightly answer some of your phone calls for you. No, it has to improve your customer relationships, right? This is a serious discussion for adults and real big companies. And I'm watching that thinking, wow, that's ServiceNow adverts like gash. And no, not only that, they're wasting loads of their money with this stuff. And I saw another one, right, like a couple of weeks ago, and they were talking about, blah, 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 orchestration, ServiceNow, blah, 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 whoa, integrate with your tech stack. And it's like total bollocks, right? It is total bollocks, because what you would know if you paid attention at that arc, the ServiceNow arc, is invent some shit that adds to your overhead and your tech stack, creates a fucking headache for everyone who works for you, no solution, just more problems, right? It breaks. At the same time, you hear on BBC4 and you're waiting to work in the morning, every other manager like you is experiencing massive downtime because their tech stack's so unreliable, because something's upgraded so frequently, and because the companies themselves keep changing their crap, and they wish they never bought into this AI white noise in the first place. And then they're talking about it on Radio 4. Like, blah, 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 blah. Oh, you need better orchestration, right? All that stuff, right? And then the enterprise, like the proper industry level reports come out, and these things costing like 10 grand just to get a copy of the PDF. And they say things like interviews with the top 1,000 managers in any one given sector, and people who are sitting on contracts with like 100 million each. What's the biggest problem with your AI stuff? The whole thing keeps falling apart, right? I don't know how to stick it all together. AI orchestration is a massive problem, and that's actually what like LivePerson's tagline is. Not just the conversational cloud. It's about how to deploy at scale reliably, and that's what the service delivers, right? So a lot of people would initially thought when they looked at LivePerson, I maybe heard of that company, they launched in the late 90s before the dot-com bubble. This is a really, really established firm. And initially what they did was put the chat box on the website, and their innovation would be it forwarded you to a real live person should you hit a wall on that chat box. Those chat bots on websites didn't always had that feature, and LivePerson managed to really make bank off the back of it. And then AI comes along. What is it? It's going to take a period of transition, right? These customers, and those, I'm talking about the clients who use the service, and then they're using it on their website, right, for customers like to buy medication, whatever. That needed to be upgraded. It cost a lot of money, and they provide a back end to it that's AI. And when you're this stage of the AI revolution, right, you're only a couple of years into it, the back end, the infrastructure and the logistics of it are still yet to be built, that it's not necessarily guaranteed that every rock you dig up is going to have gold underneath it. And like, it takes a while to develop a real strategy, a real product that customers need and want, and there's going to be a degree of churn. And LivePerson focused on developing something that the customers wanted. That's been their initial focus from the new board coming in. A lot of people were saying to John Sabino when he first started, like, you need to focus on getting your own AI model. And he thought that that would be a ridiculous suggestion when there's already lots of different AI models. Who needs to sell into that marketplace when those same people who are buying those models are all confused as to how the hell they get the most out of the thing? They don't know what parts work together. Often many don't. And they need an orchestration thing. And then you've got the best route into it if your product intersects between them and their customers, right? You can deploy this product, it'll improve the relationship with your customers, and that's a great way to get AI into your value chain, which is how this company is evolving. Now, these people with 100 billion contracts that operate on Google Enterprise, and they've got direct line then to the CIO of whichever firm it is you're working with, because that's how it works. There's a bell curve in these sort of companies, right? You're working with like typically you'll be working with the sales team or somebody not on the board, and that's going to be like their small customers where not much is going on. Then you've got like lots of people who'll be working with the tech guy at the firm will be deploying LivePerson, negotiating the contracts and whatnot. And then on the other side of distribution, it's very few again. You're speaking to the very top guys at the company. And like the biggest companies, right, they're at that third stage, and they don't need, they do delegate very well, but they want to understand that the things that are being implemented in the business, and you're getting real product managers who've got actual decision-making power now speaking to John Sabino and the other people at LivePerson, as opposed to having to go through multiple layers of management, which means that your product sales cycle is greatly reduced, which means that your pipeline can be fuller, and you can then look to a period of growth, which is all of these things are coming together. Now I could be articulating it slightly better, but that's the picture they're painting in the call, that less and less customers are leaving, revenue while declining is stabilizing, costs have been reduced greatly. We can see that CapEx is a little bit of room for it now at the start of this year. They're going to have closed that off in the next couple of weeks, at which point it's looking towards growth to becoming a profitable company, which times perfectly for paying off the final tranche of debt. Not that they need to do it, because they just need to show a positive trajectory and they'll be able to operate under better conditions. Likely the share price now finds a little bit less pressure to the downside. Not that it's going to stop going down, but it would take less to push it up again. And it's true to say that the company still operates under the assumption that it's going to have to pay this debt. Now, it's going to renegotiate, that's the intention of the board, but at some stage it'll have to be paid. And that'll cost money. They've got 60 million covenant, which means they can't drop below that in the bank account, or it'll trigger certain consequences. Similarly, paying down the remaining amount of debt ought to be done before September 2026 in order to create the best circumstances subsequently. So that leaves a period of time between midpoint 2026 and September where we're going to look at the critical nature of the communication from the board, because that's the real inflection point. That's where all roads meet and where the real move could actually happen. Like, the company share price might go to lots of different levels, but within the first short period after that watershed moment, we expect to see those most rapid moves, the biggest torque and the greatest acceleration. So there might be something happening there. And when you can already see the horizon, the steps to take to get there are very clear, and that everybody's just had an earnings call where the sentiment was very positive and new products have been launched and they're not even being priced in for future revenue, then it could be that the story gathers pace. And having seen it push up to $3.42, I mean, that's a big percentage move there from the lows. So you might anticipate there being a degree of profiting. But just the lows on that move, 8 hours ago, it's a 30% move in 4 hours, right? That's extremely good to see. The post-market prices subsequently aren't going to be as able to support price on a decline. So it might take a significant purchase to push it up. It doesn't take something quite so significant to push it back down again, because there is no liquidity there. The trade has just happened, it cleared out the books, it moved up there, and it's post-market, so there's less people buying, and then there's that distortion on the market which leads to price retracing. But it signifies interest, and coming as it does on a day with a low of 266, a high on the move of 340, 350. Not bad. Executive, $35. Bloody hell. So I kind of missed the call and just tuned in. Still bullish long term. Thanks for everything. Executive, I'm very bullish on it. Yeah, because my thesis on this thing, you know, right, cast your mind back to what was happening when we first talked about LivePerson, right? There was a lot of people were invested in GameStop alongside me, and some of that conversation was getting damaging for the investor base who were going to leave, and they were looking to go somewhere which was either out of the stock market entirely or to find an opportunity that reflected their goals when they first got into GameStop. They didn't find that it was happening there, right? There was a degree of fatigue. Now, at the same time, there was a lot of excitement because people here had learned a lot more about their own goals, and they were acting with much more intention towards those goals. And it seemed that the opportunity presented by various companies that were in distressed positions might lead to outsized moves long term. And LivePerson, being as it is and was then a small market cap company, it looked like an interesting opportunity. And then when the new board's plan was articulated, we understood that there was a real chance here for this company to actually make a go of it. A go of it so much that it would demonstrate it had a positive trajectory, so its biggest creditors would be inclined to negotiate positively with it. That would give it a runway, would extend it out so that it had several more years ahead of it, and that would relieve the share price. And that relief on the share price would come from the fact that the company is currently valued at less than its annual revenue, right? That means that every dollar deployed into LivePerson costs you the same amount if you're, say, American Airlines. But as soon as it arrives, the accountants value that dollar at about 20 cents, or sometimes 16 cents, sometimes lower, based on the market cap of LivePerson and the amount of money that's going through the door, right? So that's a material difference between those two numbers. And when the company itself demonstrates a positive trajectory, it looks like it's going to survive for several more years. Roaring Kitty described it, Keith Gillis, that's when you know there's a chance this thing's going to run, right? The other side of the trade's like, oh shit, this thing might actually pop. And that's exactly the position LivePerson is in, because just returning to a positive trajectory might lead to the share price expanding to the same ratio that is currently depressed based on the contracts to the underlying, right? So you're looking at an expansion and what is often referred to by market commentators as a price reset. But in fact, it's just an algorithmic change in the way that companies are valued. And that likely leads the company you go through a phase in price that takes it back to what it's judged by analysts to be fair value. The average current, like if you look into it at the minute, like the 3 analysts that look at LivePerson and give it a valuation at the minute, their average share price that they think it should be is $11.50, right? That's before they were on the phone asking about this brand new product. And so there's clearly a lot of upside potential there if the company itself manages to demonstrate and articulate that trajectory is real. And so am I bullish about LivePerson, right? This is my thesis on the company. We looked at the charts. We saw that there was technical artifacts that suggested that more was to be known outside the public story, that there was some sort of machinations going on behind the scenes that suggested the numbers painted on the wall, the distress that was marking the company, was potentially not as bad as it might have been for others, because having looked at distressed companies, having looked at those that have had a strong move to the top side and then a strong, steep, continued, sustained downtrend that took it back 80% of its true value, and looked through these companies and the different debt obligations they all have, we discovered different things with regards to the covenants, aspects to the public filings that suggested similarities with previous plays we've already done before, right? And people who were there will be able to tell you what the tickers are. And we saw similar pictures on the charts, and we thought, well, there's a potential here for this thing to hold important levels, which would suggest there's other investors behind, and the structure of the deals that underpin the company's debt might actually be quite favorable to them. And so what's happened since then? Well, that was a huge, staggering, critical death issue with regards to the debt, right? It was huge, massive debt dome over the sky. And that company, suffering under it, that was why the price was going down in such a desperate, rapid pace. That pace has been arrested, thank goodness. But it was going down quick, and they managed to renegotiate that debt, right? They managed to pay it off a ridiculous discount. Now, a lot of people who were investing in advance of it felt stung by it. It came at the same time as a reverse split, which puts a lot of people off and creates negative sentiment just by default. And that all happened on one of the last days that the company was trading above $1 and would have achieved compliance, which we would have taken a lot of pride from because we were adding significant levels to the buying power. Right now, I can tell you that was definitely happening. I don't need to look at anybody else to tell you it's true. So a lot of us felt that sting. And if you were emotional about things, perhaps your sentiment on the company would have changed at that moment. But with a pragmatic investment, and we were looking at things that I think only maybe, I don't want I don't want to seem like I'm a lunatic, right? But I do think everybody else is crazy. And it's perfectly understandable that everybody else would tell you I'm crazy right now. But I think that I've seen this before. And not just once, and not just twice, but a few times now. And I think it'll turn out the same way that went. So my thesis still holds. It's that the new board are going to go through a turnaround phase. And that turnaround phase has to be extremely pragmatic, right? I don't want some jazzy twat trying to talk like it's good, right? And then fake it till you make it and use buzzwords and just say bullshit at earnings calls to get everybody hyped and just some bollocks, right? I don't want that. I don't want them releasing press statements about their own share price. I don't want them doing all the crap you see on all the other YouTube channels that try to say, well, this is how investing works. Oh, this is that, and all these amateur attempts at things. I would rather than convert this company into a meme stock, I'd rather convert our community into like a real serious group of investors. Now that's where it began with Rocky Outcrop and the moves he's done on Bitcoin since the thing was trading at just, since Ethereum was $5 and Sol didn't exist and he was mining it on top of his fridge back in, the early, we want to take, this is, there was a huge departure in where this generation of investors could have ended up and currently are at the minute, right? You can say that's because of inadequate government policy. You can say because of market mechanics. You can say because of geopolitics. You can say because of disease and lockdowns. And you could talk about all sorts of different things, right? The value of money, the amount of money, all sorts of different things. But the market, is a really good leveler, right? There is no excuses, and people say it's a mirror. So if you can find an opportunity that will create serious discussions, invite serious analysis, require serious commitment and conviction, and therefore serious risk management, and you can commit that behind a board who are serious people with a serious plan that makes sense, that understand the context of the company, right? Context of the company was, you need to prove that there's real economic value in this business and your reputation depends upon it. Your reward, if you get it right, is nearly entirely linked to the share price. We'll give you money because you could do other jobs. But we're giving you far more incentive if the share price goes up. They said that to John Sabino. He came on, he's the new CEO. The previous interim CEO is John Collins, who himself has a background in the money markets. I think he understands things the same way I do. I think that's why I see things on the chart that I see, because John Collins is there. And he stayed on with the new board. They fired nearly everybody else. They got rid of everybody else, but they kept him on. And he demonstrates his value every one of these calls, and he knows how to work this. He knows how to work the levers, and they've got a serious plan which focuses on being realistic, right? Not going to create a new AI model to compete with ChatGPT. That was always a stupid idea, and if any valuation was based on that idea, then those people aren't going to be made happy by this board. But if your idea is that there's a lot of white noise in AI, that you yourself have experienced, the quality of the product you use is not matching the hype with which the whole world talks about it, okay? It's not, right? It still isn't. It certainly wasn't when we started. It just isn't, right? And it's not getting any fucking closer either. So you need products that are going to bridge that gap, not products that are going to ignore that it exists. And board level conversations, which you can go back and check, it's all over the world, everyone was talking about it at the time. AI is a lot of shit. It doesn't do what it says on the tin. And when I buy a product that replaces staff, it goddamn needs to do what it says on the tin. And this, right, whereas instead of being, right, like a fucking tin opener, you saw the original memes, right? Mum would have rather had a can opener, right? That was the idea, right? There's a lot of that shit floating around. And so a company that addresses that reality and a board that embraces that truth is radically different from the previous positioning of LivePerson. And it's exactly what's needed to turn this company around. Also, these are people with real experience in this exact moment at taking a company from where it is at the minute to a massive valuation and selling the thing. And that's right up my street, right? Because I don't want to trade something that's going to spike one day to 50x, and by the middle of that afternoon it'll have come back down again because the CEO or the guy who invested in it that caused the pump fucking was actually selling into that liquidity and you were all his exit. I'm not interested in that. I want to lead people over a hill to something better. And some of the things that the CEO of GameStop does and says personally offends me. So while I manage my investment there with the commitments I originally made and the truth of which I put across with this channel, I still felt like I'd rather level up with someone else. So, but it has to be a pragmatic investment. It has to make sense. It has, because you're going to be taking people with you, probably. Not that I fucking want you to. The whole thing's crazy and you shouldn't invest in this thing. It's completely ridiculous, right? The price is where it is for a reason. They've got shitloads of debt they have to pay off, right? These are just to John and John, right? They're not fucking Superman and whoever else is like, this is, so they're just real human beings. So you have to be pragmatic about it. You have to choose an investment that makes sense and also achieves these goals, which are fucking massive, right? You're looking for people to, you know, you have to find an opportunity that is realistic on some level, and can, and realistically on some level, achieve something similar to what people want to happen on GameStop. That's a massively difficult find, right? So, has anything happened to convince me that this board can't generate enough cash so that their biggest creditor, who's also one of their biggest shareholders, believes that it is possible that they make it out of the shitter, right? And what's changed? The biggest material difference since I first said lisping to this second now is a debt for equity deal, which exchanged lots and lots of money for a lot less equity. But that equity is there written in your face. It's the equity upside to the largest creditor, right? So the company going bankrupt is not in the interests of the people who they owe the money to, okay? Which is why it's so frustrating when the market narrative is this thing is going the same way as Bed Bath & Beyond, which it signed a death spiraling debt deal, which meant that the creditors could take greater and greater chunks out of the thing as it dropped in market cap, which is a nightmare. That is not what happened with LivePerson. John Sabino would never have signed that deal. I would never have backed somebody who would have. And that's why this is totally different. So when people say that, it's like, no, you're literally, like, it's not worth having a conversation with those people. But it's a reminder of how irrational much of the market is, because we all have access to the same information. Now, it's completely ridiculous for me to believe that everybody would respond in the same way to the same information. Of course, that's not what I would believe, but I would at least think that the distinctions were obvious because I was myself advocating for this opportunity. But that's massive hubris, because people have short memories and they forget what we did with GameStop. And I'm not here to tell you how good it was. I didn't even mention the tickers that did what we've talking about happening here before, but you'll be able to look it up because it happened. So anyway, right, this is a huge opportunity. I think that it's a very risky opportunity, and I don't recommend other people go for it, right? Now, I'm not a financial advisor, and I never recommend people take this opportunity. Never. I don't ever think anybody should do this, right? I think that this channel, maybe, and this should have always been a spectator sport. You're absolutely mad in the head if you own any LivePerson. One of the reasons we started talking about it that was because that's responsible. You know, it is responsible that when you get into this thing, it comes with a health warning, right? And it's one of the few stocks you'll ever see promoted by an influencer in terms of its general availability to trade that comes with such a strong and clear health warning, right? That's out there and obvious and has been for a long time. And it's written in a fucking stone. And the only change that's happened since we started the thesis, it's a massively beneficial debt for equity deal. It's massive, absolutely massive. And why does it not have a material impact on the share price? Because they've still got a tranche of the debt left. That tranche has triggers that'll be set off if things don't happen before September. So we're looking for things to start happening before September. That means we have defined what those things need to be and have a roadmap towards being successful. Successful is over there and we're over here. Now we can see where it is, but that doesn't mean the share price has to fucking live over there yet, right? It's still dangerous. The company might not execute properly. And execution is the biggest risk in any investment you ever make. Because the guy running the company could have he could have a penalty, right? It could be this good, right? You could be in the final of the best tournament of your life that exists on planet Earth, right? And the goal could be fucking massive, which is the size all goals are in all sports that are worth playing. They're all massive. And the person protecting that goal, relative to the size of that goal, will be tiny, right? They'll only fill up a very small space within that massive goal, as is true of all goals in all sports that are worth playing. And then you'll be then given the football, maybe, or any other ball, to take this shot or strike, or however I describe it, into that goal. And let's face it, right? It's fucking easy, right? It's easy. It's perhaps the easiest thing anyone will ever ask you to do. And it could be on the World Cup in the final in the biggest game of your life, as in the motivation to succeed could not be greater. And yet the person taking that shot could be James Tavernier against Celtic in the cup, playing again at the end of the game. It could be after extra time, 24 shots to 1, that one off target, and he could miss the penalty. He could be such a dumbass after all these years being beaten by Celtic, after all these times they've been defeated, and this one opportunity at home where it could not be easier, it could not be clearer. It's their second choice goalkeeper. He's tiny, goals are massive, behind them tens of thousands of your own fans and nobody else. And everybody in every institution is dying for you to succeed, and you can still miss. So there's a huge risk in execution, no matter what it is, no matter if it's an investment, a sport, or the person trying to cross the road. There's always a danger they'll completely mess it up. And there's no accounting for it, there's no explaining it afterwards, and all you can say is that the guy could not handle it. And it may well be the case that some of my investments I look back on and I say the thesis changed, and it was because the guy responsible for scoring the goal was not capable. But I don't think that John Sabino and John Collins are going to miss that penalty. I think they've done everything right. I think the goal is open for them and it'll be an easy tap-in. And I think that they've set themselves up perfectly for it to happen in the middle of 2026, which is also when Scotland are going to be in the World Cup in America. Well, if that all works out fine and, you know, everything turns up Millhouse, maybe we'll all be meeting up as Scotland score more overheads and, you know, this is what dreams are made of. So you're looking at the pragmatic investment. Has the thesis changed? No, it's only got better. Has the share price gone down? Yes, significantly. Significantly. There's always the risk that would happen, right? And heavy is the crown. It's not like we look at John Sabino and have, like, and I like what happened with GameStop. I'm still, like, where people might not like it, right? And I'm not being arrogant, but like there's some cultural touch points within what happened in GameStop, and we're one of them, right? And like you could go back and analyze it, and if you were doing it properly, you'd have to include some of the things we did. Now, it still lives on, and there is no real corner of the world that's got any remaining credibility other than ours and the Rocky Outcrop Discord, who have had a consistent position since the original squeeze. There just isn't anywhere else, right? Like, that's not a critique, it's a fact. And it would be others that would try to distance me from what will happen in GameStop in the future. But it's me who'll distance any harm that might unintentionally be caused to people in our community from actions out there that I can't control. And so we focus on LivePerson, where the CEO won't be making decisions that I personally feel offended by, who won't be missing this penalty like James Tavernier did, with an opportunity that presents something capable of mirroring what the people who originally were looking to invest in GameStop tried hard to achieve. And that is a company that can actually turn it around from going into the rocks at speed and manages to turn it around. The reason it'll do that, when it's already got good technology, it already has good customers, it already has a vision and a history behind it and a vision going forward. And all it needs to do is deal with debt, because debt is the problem. You see, this company actually, even though, right, you put $1 into the thing, right, and they earn, what is it they're going to earn next year after revenue declines again, right? Approximately $200 million. What's the value of the market cap of this thing, right? Well, it's like 40 million, like not even, right? $1 million. So that's a fifth. So a fifth. That's a fifth, right? A fifth. So you would imagine that every dollar that gets spent with LivePerson is turning into 20 cents of value, because that's what it is to the investor, right? It's currently cost 20 cents. Of every dollar invested, you can buy that dollar for 20 cents. That's what LivePerson trading at 273 provides you. When people like British Telecom or American Airlines spend $1 on a LivePerson service, you can literally buy the economic value of that dollar for 20 cents, right? You can get it for 20 cents. That's a fact. And what happens to that $1, right? Well, you've just had the call released, which describes the margin, right? You're looking at the details, you'll see the margin there. Margin on this product, what's my battery value? My battery's gone up. What the fuck? I closed programs, but I didn't imagine that would happen. Everything is looking up. Everything is turning up, Millhouse. That's magic, right? The Chinese will be glad to hear about that. So, every dollar that gets spent on LivePerson, every $1 turns into 20 cents if you want to buy that $1. And that revenue will keep it going on in future. So you're getting 20 cents for $1 spent this year, which will also be spent next year. At least 79% of them will be. And so you're getting a lot of money for that 20 cents. And what do LivePerson do with that $1? Well, they've got a margin of 71%, right? So of that dollar, 71% is after they've spent all the costs on what it takes to provide the thing that the guy paid $1 for. So American Airlines spend $1, LivePerson do everything the guy expects, right? He's called American Airlines, so let's call him a guy, or a girl, with a gal, expects. LivePerson's done all that by the time they spent 29 cents. And the rest of that 71 cents is going to pay off fucking interest on a fucking debt that was taken out by the previous CEO, who was a total tube and wouldn't leave on time, so they had to take this poison pill which stops our community owning more of this thing, which is why so many of us, anyway, getting cut off there, the only reason they've got this debt is because at this height of COVID, this guy borrowed shitloads of money on ridiculous terms, and then quite rightly has been booted out of the company. But unfortunately, you can't just boot your obligations out like that, right? You have to pay them off. So that's what the company is currently doing. And it's managed to do it in great swaths. So that only a very minor amount of it relative to the initial beginning is actually still left. And now they've positioned it so that the person they owe that money to is also a massive shareholder in the business. So they've got huge equity upside. So the narrative is that the people who could kill it want it to survive, obviously, because not only did they get their money back because it survives, but the value of the company goes up. because it's going to survive. So that's great. And you can invest alongside this thing. $1 spent, you can buy it for 20 cents, and it'll be 79% of those dollars will be $1 next year, and you're getting it for 20 cents. And in the meantime, when LivePerson hold on to it for you, they're going to do everything the guy spent in 29 cents. And the rest of that 71 cents, once it's paid off debt, is margin. And that margin is fucking massive. And that's for a software as a service company. 40 to 60% is good to very good. 70 to 85% is absolutely fucking ridiculous. So we have here an opportunity. That opportunity is huge. It's unseen. It's recognized it in charts we saw before. They've got a board who can handle the job in front of them. They've positioned the company to achieve all the things it needed to since they started working on that plan. And so once that final tranche of debt is gone, 71 cents of every dollar spent on that company is going to be going to growing that company. And this is a company that you can buy that growth, that future growth, you can buy all of it, for 20 cents on the dollar.